Good day, everybody. It's Greg Schnell, and I am here with the Canadian Technicians Report for July the 20th, 2019. Thanks for taking the time to join me. Lots in this report that makes me nervous. Yeah, working through the charts, numerous things came up that make the situation quite frail. I know it's only 1 week down. There's a lot of underlying stuff underneath the surface that was quite odd. So anyway, we're going to go through that right now. Again, to find all of my blogs, StockCharts.com, go to the Articles tab, drop down menu on the right, and there's the Canadian Technician. Don't ignore this chart and chart watchers. And please hit subscribe at the bottom if you'd like to get those in your mailbox regularly. You can always reach me, Greg S. at StockCharts.com, and on Twitter at Schnell Investor. Today's agenda. The bull's argument gets corralled, and one of the concerns that I've been having is that the market has gone up and up and up, even though we expect earnings declines. And the real problem for me, is that as the market goes higher and yet earnings get suppressed, and everybody says, well, they've downgraded the earnings expectations. Yeah, but the real earnings are down a couple of percentage points from last year. So it makes it more difficult for the market to keep going higher. Some of the things that are starting to happen is the transportation stocks are starting to slow down, albeit airlines are having a little bit better time here. They've got less planes in the air, but they're starting to make better revenue per seat mile. So some money coming to them that way. There were a lot of outside reversals in some of the big names and some of the big sectors. Some of the leadership groups had some real interesting chart patterns. Markets took a big step toward correction, and one of the things I try to look for is just the breadth of information, how everything's looking. And one of the things that happened this week was a huge number of groups lost momentum and are actually, their momentum levels are lower than they were a couple of weeks ago already. Russell and the TSX are problematic, and one of the reasons I say that is the TSX usually breaks down before the S&P 500. The TSX topped out in April and really hasn't been able to get any kind of thrust going since there, and the Russell continues to struggle to do any sort of a breakout. And this week the NASDAQ composite broke out and then actually failed the breakout, and the S&P broke out 2 weeks ago, hasn't really made any headway, and then this week kind of pulled back from it. So it hasn't broken down yet, but it's pretty close. The rest of the world is another problem. Well, what I mean by that is there's a couple of different ways to look at the rest of the world individually by country, or using some of the grouping ETFs, but the bottom line is they fell hard they fell hard 2 weeks ago, this past week, and this current week. And so with that, they're 3 weeks of downsides, and I usually expect the rest of the world to pull back before the US. And Japan, the central bank was buying heavy, trying to hold things up here. They bought $3.5 billion worth of ETFs this month so far. So that's starting to step on the gas pedal. And some of my cautionary indicators are firing up just in terms of the levels they're at. And if they were going to fail here, that would be a big deal. So lots to cover off. Let's get into it. First of all, this chart, just really simply, when the trend lines break, it's usually a good place to be cautious. Obviously, this break in September was significant. One of the things we need to notice is that we still have a lower high on the NASDAQ, even though we have a slightly higher high in price. And with that difference, we're starting to see, a level that would be kind of treacherous isn't the right word, but concerning, because we have a lower high in the advanced decline line, and we don't have it on the New York Composite, and I'll show you the S&P 1500 in a sec. But this is starting to suggest that there might be breakdowns. And again, the big charts don't fail first. It's the little ones that do. But you can already see the advanced decline line has started to fall down here. And again, is it this week or is it next week? Well, the data would suggest that maybe we've got one more week. But I want to point out that the September-October topping structure. What happened here was in September, we had options expiration, and then 10 days later, we had the Fed meeting, kind of October 1st-ish, and everything literally fell quite hard. And so it was quite concerning, and actually we'll get into the Fed dates in a second. I might have the order backwards, but the bottom line was they reversed relatively close to each other, and down we went. And so here we have this same setup where we had the Fed meeting and the options expiration. So we've just had the options expiration. Fed meeting is 10 days out. And so it feels to me similar. And some of the data patterns underneath the surface are similar to this so far. Okay, and now here's the NASDAQ high-low, and what you can see is, again, we still haven't got this breakout. We're kind of struggling in this range, and this is very similar to like 2015, and as we hit the highs there in 2015, then we broke down. So I was kind of hopeful when we started to see this stab up. That was helpful. Now, when I look at the New York Composite, the data is a little bit better, and the reason that the data is better is we haven't got near the trend line yet on the advanced decline line, and at least it made a higher high than the NASDAQ, whereas the NASDAQ's made a lower high on the advanced decline. Now, we're still sitting here, and I've just moved this line up to just show you that we're really close to trying to break through these prior highs, but haven't been able to do that. And that would be the main September high that we hit, September 21st-ish or something, I think, for the New York Composite. Now, looking at the high-low data, we have this flicker up here that suggests a better bull market level of activity, and that's kind of what we were waiting for to see. And it looks more. It looks more solid, or it looks better than even back in 2016 coming out of the lows. I think the real question is back here in 2014 when everything pulled back in that September and we rallied up and we had some spikes up here. It was okay, but then all of a sudden the market kind of lost confidence. And so one of the things I'm worried about, in May we had that big pullback, and now do we come up, is that kind of this sort of response in here where we had a dip, then we pull up, and then we give it all back. So I'm a little bit worried about that. So far we're still way better than we were in the April-May timeframe in terms of high-low data, and we're still climbing. So to me, I still have to lean a little bit more bullish when I look at this chart. Now, looking at the 1500, and this was from Arthur Hill, one of the things I want to point out on this one is we've already, just using the 11-period EMA, so the same things I use on the other two, the New York and the NASDAQ composites, we can see that this is pulling down below zero already. This trend line hasn't broken, and if the trend line breaks, that obviously is concerning, and this trend line here was a good clue. So we have a little bit of space in here, but not a lot. And then from the market perspective, obviously, we're well above the trend line here. Whereas in here, this was also breaking down almost coincidentally with the advanced decline line. So I'd say we have a week or two to kind of learn if this is going to get more serious, but it wasn't a very good showing. For the Canadian market, what we see here is, again, we made this high back in April, and we haven't been able to push it above it here. And, we might have an intraday high or something like that, but we haven't been able to close up above it. And we sit here and this all looks pretty good. One of the problems is we had a huge rally in the gold stocks this week. I mean, they were on fire. And so the whole group was advancing, all of the precious metals, which is one of the bigger industry groups in Canada as a commodity country. And yet we were still unable to get any sort of advanced decline line energy going. And I think the financials and energy haven't participated. So that's kind of 2 out of the 3 didn't participate. So that's an issue. Now looking here, we're right at the zero level, so it's not time to exactly yell fire in the crowded theater, but it is a cautionary level to be watchful of, where we just can't get any sort of emotion going. And back here in July, August of last year, the Canadian market topped out in July, whereas the US market topped out the end of September. That was roughly a 2.5 month time frame. Here we're almost at 3 months. So if the Canadian market starts to weaken, I think that would be a pretty good sign that we need to be more careful. And here's the high-low data for Canada. And again, much like the NASDAQ, we haven't been able to flicker and turn the lights on and get up to a level that's really, breaking out into a big bull market. We've had enough to rally, but haven't had enough to keep a sustained rally going. So watchful. And again, this little spike in here on the end was pretty much gold stocks. So here's the high-low data, and this is the Alexander Elder, where he adds 5 days in a row together, and we're still holding up okay here. This chart looks a little bit more positive. You can see in May it took for kind of a couple of weeks for it to even get to negative. Well, we haven't got to negative yet. So I know the market was only down 1.7% or something. It wasn't that huge, but the big issue is a lot of things have changed. So McClellan oscillator's now below zero, and this is a 5-year chart or something like that. And you could just see that if we're down below this zero level, that's not that worrisome. We're still up around 800. That's bullish. And when this gets below 400, that's more of a problem. But it is starting to roll over. Showing the summation index here, we're up around that 800 again. It would have to fall all the way down to this 400 level. That's kind of the note I've got on the chart here that usually creates a bigger market pullback. And you can see in 2010, we kind of had this big thrust, and then we ran up, and then as we worked our way lower, and it was one of these work your way lowers that we had the pullback of roughly 10%. Now, we had this big trip down here, 20% at the end of 2018, and we've rallied back up. Now, I don't know if that puts us all the way over here kind of thing or what, but I get the feeling that the market is a bit suspended without a lot of support under it, just based on some of the data that came in this week. The NASDAQ is still rallying up here on the summation index. It did start to turn around, but it hasn't really started to drop hard. And in this particular case, it has to go below zero or 200. And you can see back in 2015, you might remember it was the October time frame that we started to fall off here. So it was up around this zero level, and we fell, and then that was kind of when the market started to let go. So we have a little bit more to keep watching for here in the overall market for the indexes to lose their breadth. But from a momentum perspective, we definitely had a big kind of drop. Okay, on this one, this is the bullish percent index. And what I want to talk about here is we're up around the 50 level. We haven't really had a lot of enthusiasm, so considering how big the advance has been off the lows, we still only have 50% of the stocks on the NASDAQ on a buy signal, which quite frankly isn't a lot. And so what I don't like to see here is the fact that we're only around the 50% level from the percentage of stocks above the 200-day moving average. And you can see back in 04, 05, this was kind of a typical level that we got to. But in 2007, we kind of got above it. We pulled back, and then on our final rally, and then we fell below. And so we fell below, and then we rallied back up. And in that rally in mid-08, we only got up to, let's say, 40% or 30%, and up here we only got to 40%. Well, we're up around 50% instead. But it's still not a wholehearted, it's not everything's running, it's just all the big names are running. So looking at the NASDAQ 100, you go back and you look, well, even in October 2007, which was a market high, the NASDAQ 100 actually got all the way up into this kind of between these two lines. We were recently above it, but again, back in January, the big pullback we had in January of 2018, the market wobbled quite significantly there, and we were well above it before we started to break down. So this isn't as helpful to learn from, and you can see the percentage of stocks above the 200-day moving average as 80%. And back in October of 2007, it was 80%. And in these pullbacks in 2006, it got up to the same sorts of levels. So I would say they're at the extreme levels, and if they can stay up here, that's very bullish. The real question is, we've been dropping not meaningfully from 80 to 77%, and the market doesn't really drop hard till it gets below 60. But the one thing I will say we did see in the underlying data this week was that a lot of groups that had built up quite significant momentum have really started to lose that momentum over the last few weeks as we've been trying to break through the highs. So people have been selling into the rallies lately. Okay, for the New York Composite, what we see here is just barely above 55%. And again, this is worrisome because we didn't get all the way back up for the whole group into big bull market run mode. And that's what I keep waiting for. And some people will say it doesn't matter, just invest in the big stocks and leave all the other ones behind. What I use this data for is to show that once the weaker stocks start to fall away, that eventually becomes where the big stocks fall away. And it's the advance warning that we're trying to get from this system, rather than waiting for the cliff and then go, gee, I didn't see that coming. And I have again, maybe it's too paranoid or whatever to try and be looking for issues. I'm not really looking for issues. I'm just showing you that in terms of data feed here, we've only got 55% of the stocks on a buy signal. And looking back when the market kind of tops out in this sort of area, that's not a healthy period. 2000 to 2002, this was low. In 07, 08, 09, this was low. In 2015, we got up to these levels and couldn't do anything more. And then more recently, for this big sideways move here, from January of 2018 to today, we're marginally higher, but we're not really high. And what you can see is the broad number of stocks haven't really participated. So using history as a guide, there's really 4 or 5 pockets on here that you can look at. And I would just say that we look similar to the weaker pockets, not to these big pockets of huge strength where we had nice broad breadth. Okay, the S&P 500, again, it looks great, and that's because it's just such a big index, and it's up here around the 75. But look at how high it was in January 2018, where it just felt so bullish, everything was raging, and then it literally dropped quickly. And that drop was, 10% or something in a couple of weeks. Things went down pretty fast. The underlying data, so again, the NASDAQ composite and the New York Composite both didn't get going. And so that's one of the concerns that I have, is we're kind of up here gasping for air with only the large cap stocks, and the small caps haven't participated. And that's kind of what the Russell has been telling us. Now, the TSX actually had more stocks go on a buy signal, with some of the gold stocks jumping up. But we didn't have any more stocks move above their 200-day moving average. So we still have 65. And while that's not a bad percentage, it's not great. It's definitely not in these big bull market thrusts. And so, again, we're sitting here. We've been declining for a couple of weeks. It's not that bad yet. It's the culmination of all of this data adding together that worries me. Now, the energy sector is interesting this week because Friday afternoon, with the shooting down of the drone earlier in the day, and then in the afternoon, Iran taking one of the British flagged oil tankers, that was a big deal. And so all of a sudden oil rallied. So we haven't seen any effect in the price of oil here, and we'll watch very closely to see what happens early in the upcoming week. But we might find that there gets a bid under oil if the Strait of Hormuz is going to be under pressure here. Looking at this chart, and I want to focus down here on this bottom corner. And the reason I want to focus on this is starting to turn up. Now, what is this? This is bullish percent index momentum. And so it's momentum on an indicator, which is fraught with danger. But one of the things it's helped us do is identify these really big bottoms that have been viable dips. And right now, you can see back here in 2018, pulled down and bounced up for that level. We're at a very similar level here, well, relative to the signal line. This one actually got a little deeper, but it looks like it's already starting to turn up. So from this high level, and what we want to watch and see is, do we get a big bounce here? And again, if the oil's going to have a bit of a run, this might be one of the areas that we start to see it in. On this scale is the oil services, and you could just see they're drilling in the bottom right-hand corner. That's not very helpful. And the other thing that you'll notice on this chart is roughly every 3 years we get a big low in oil. That down here in momentum, well, we've been blessed with having two very close together, and the good question is, are we going to have another one either late 2019 or early 2020, and that becomes our next big viable dip, and then we take off from there. Okay, gold mining index, actually gold rocketed up this week, and we did see a lot of price action that was very good. On Wednesday and Thursday, there was some serious acceleration. This is the gold miners, and these two big bars might suggest that this needs a bit of a pause. There was just a little bit of euphoria going on. And even on Friday, we had an inside bar on gold up here at the top, where the previous day the range was X and the high was lower and the low was higher than the previous day. So we call that an inside day, and notice how we closed right near the lower bar. If this starts to break down here below the prior day's low, or even in this case now below this bar, I'd expect that we could probably go a little bit weaker, because that was quite a bit of euphoria and we had lots of volume show up on that in gold. So that's going to be an area that we need to focus on, but I actually expect it to pull back, not kind of expand. Okay, so here we are with the options expiration data, and what you see is the options expiration data back for September, call it 21st, was right around here. And then the Fed meeting was late in the month, or October 1-ish or something like that. And it was literally the culmination of those two, and then down we went. And the market really, in this point, we saw a whole bunch of sectors start to lose momentum, and that's what I saw this week. And it wasn't so much last week, but this week it's set up to almost the same tempo as we had going into this week here. So now what we're watching for is, do we get the follow-on in the upcoming week as we head into the Fed meeting on the Wednesday, Friday, or the Tuesday, Wednesday to end the month. So lots of reasons to pay attention here. It makes me more concerned that we could end up having a bit more trouble. And one of the reasons for that trouble would be that as we come through this period, again, we're trying to break out to the upside here, in the NASDAQ has given back and closed, just slightly lower than this previous high set up here in May. The S&P is still above the previous high, but it wasn't a very positive day here, with a full reversal even after the great earnings out of Microsoft. So that suggests to me some caution when we get great earnings from a big company, the biggest company in the world right now, and the market can't rally on the back of that. So with that, this is the Fed meetings, and what we see here, again, going back to that September-October timeframe, we had the Fed meeting in there, and then when the Fed meeting was finished, and all of a sudden, market held in for a couple of days, and then down we went. So are we good for another 2 weeks? I don't know that. I think I fully expect the Fed to cut 25 basis points, whether it needs to or not. Some people are out there hoping for 50. And again, I keep looking around, but the data doesn't look that weak to me. But when the Fed starts to cut, I think that would be an acknowledgement that the economy is getting weaker. So why wouldn't that also suggest that the market could fall from here? And it's the rest of the world that concerns me. Their growth levels are quite low, and we're probably going to skip a lot of stuff that we normally cover, and I want to show you on the other charts what's starting to happen there. So here's the S&P 500, and again, we were up around 3% from June 19th, and now we're down to 1.7, so we've lost roughly 1%, maybe 1.5%. But we might notice this shape called a small head and shoulders top over the month of July so far. And does it hold up is the real question. We've broken this short little uptrend here off late June. The next chart we can see it in bigger picture. And here we have the June low, and then we've had this nice uptrend, and it looks to me like we're going to test that this week. The slope of this line is a little more gradual than the slope of this line, but when the trend broke here at the end of May, it was a simple thing to watch for, and it literally marked, falling down. So we have the bullish end of the month, and sure enough, we finished the month right near the highs, and then down we went all the way to the low of June 1st, and then rallied straight back up out of the hole, and now we're heading into the second half of the month. So we'll see if we get that bullish end of month feeling to start the rally right here like we did back in March. Or does this actually struggle, take a few days sideways, and then end up breaking down? Just putting the S&P, the NASDAQ composite, and the Russell together. And again, you could say, let's pick the S&P, the New York composite and the NASDAQ composite, or the NASDAQ 100 and the S&P 1500. You could group it any way you like. There's different ones. The bottom line here is the Russell has gone nowhere for 5 weeks, and we've been watching it to see if it can actually start to join the party and fix that breadth issue that I mentioned earlier in the show. Here's the NASDAQ composite, and we're stuck right around these prior high levels, and we briefly broke out last week, and this week we've pulled back down. And again, this is on the back of Microsoft with the big earnings, and it couldn't hold it up. Now the S&P needs to hold above 2960 or 2950. We're at 2976, so we still got some room to work with up here. And it's in the top corner. I mean, it doesn't look like any weakness. Fully get that. I think the bigger issue is what was going on under the hood. So on the S&P, we saw 3 distribution bars this week where we had an increase in volume on a down day. And again, that would be, this was a down day, this was a down day, an up day, and the down day. So the 3 down days were actually meaningfully big down days, and we had 3 distribution bars. We had one back here on July the 8th where it was higher than the previous Friday, and the concern about that one is the 4th of July was in there. So that one's a little bit, let's call it cautious. But the bottom line is we kind of got 3 or 4 here. This sudden grouping this week suggests caution, and the PPO rolled over to kind of also give us a clue that we might have some issues. Now, it's the Russell that on the weekly charts that makes me more concerned than most of the others. But here's the NASDAQ 100 on the weekly. And what you notice is I've drawn in this line, and I think it's been there for a couple of weeks already. But what we're watching for on this particular case was that as this line starts to turn higher, we want to keep track of it and see if it rolls over here. And if it does, that usually is, a level of weakness we don't really want to see, where as we try to make a higher high, we make a lower high in momentum and fail here. And again, one of the big issues for me is it's after we've been down below zero, we can draw an upsloping trend line here. So I don't usually want to draw it cleanly off this one, but you get this kind of wave down, and then you can draw a line on here. And it's that second wave that says, yeah, we tried and we didn't have the momentum, and then we kind of draw a trend line off that, and that would be a place to check our work. So a little bit concerned about that. And what you see back here, so if we took that same anomaly and drew our trend line up here, and when it starts to break through here and then turns back higher, it doesn't make a lower high here, which is the important clue, and it kept going all the way up into here. Now here it started to make a lower high, and the market gently worked its way higher. So we still have to do a lot of work here to see how weak is the market. It's the fact that the Russell's not participating this time, whereas it was back in here. Okay, New York Composite, again, sitting right up in the top right-hand corner, but all at these same levels, just hasn't been able to get back to that January 2018 high, sitting at the September high and the May high, just literally stuck here. Now we're trying to get this momentum line to turn back up and be very bullish, something like in here. And again, this is a monthly chart. This is a pretty important place for us to get some heartbeat. Zoomed in on the New York Composite, what you can see here is, look at how small the trading range has been, and we've already put in three weeks in July. So with those 3 weeks, we haven't had a lot of price movement from the overall group, which is a bit of a surprise, I think. Would almost say after this big move up, this is a bit of an exhaustion move where we have, the Evening Star or an Abandoned Baby or whatever you want to call all of these candlestick nicknames, but no real momentum thrust. And so normally what you'd see after a big bar, you want to see another bar and another bar. This is kind of how the market goes higher. In this particular case, we've tried to, and it's been a relatively short bar after a big bar, and we haven't been able to make any real headway. Okay, so here's the Russell weekly chart. Remember how on the NASDAQ we were dealing with a PPO that was way up in the high levels here, and what we're looking for, the NASDAQ 100, what we're looking for here is the fact that this Russell's right near zero. Now, that may not bother anybody, but let me just unwind the tape here. And let's look at when the NASDAQ goes below zero. And in 2014, you had that September dip, and then it took off to the upside, and that was a big, beautiful move. And then the market topped in here. And then it came down, and it tried to rally in that October-November timeframe, and then it fell again. Well, we've run up, we've pulled back, we've tried to run up again, and we're rolling over again right at zero. And we saw this back in 2007, and we saw this in 2008, where the Russell just kind of stalls out at these low levels. And so the problem for me is we've had this dip. And again, the S&P's back to higher highs, but the Russell isn't. And over here in 2008, we kind of got here, and as the Russell rolled over right at zero, that was where the actual market topped. And when the market topped out there, this was a meaningful decline into the spring low in 2008. I'm going to pick a number, 20% or something, and then it rallied up in there and couldn't do any more. Now, the reason I think we're in this sort of environment near that 08 high, or 07 high, trying to test and break out of previous highs, this period, here's 06, call it the spring high or whatever, and then we briefly tested above it and failed, and tested above it and failed, and tested above it and failed. And over here, we had a high, got above it, failed big, came back up, and we struggled to get back above this area. All of our moving averages have rolled over. We still have a downsloping trend line. We have dropping relative strength. So I'm just not seeing the right level of participation to get me excited that things are fixed. And, again, if it all fired up, Greg, you were wrong, absolutely, I'd be thrilled with that. The problem I have is we continue to have this waning momentum, and if, a good analogy is the basketball where it bounces, and eventually it just can't go, and it falls down. And we see this over here where it would just bounce and then kind of fall harder, and then tried to bounce with no real upthrust and then fall harder. I'm not predicting an 08. I don't see any financial crisis anytime soon. What I am suggesting is the rest of the world is extremely weak, and the U.S. market is kind of on its own. And so how long can it keep holding up? And so it's this Russell chart with this really low momentum. And I mean, if you can look at this chart too, but do you see anything when the Russell goes deep below the zero line? Do you want to be a part of this, or do you want to be cautious? And I think it's this particular condition here where we were below, tried to get above, and couldn't really make any headway that concerns me significantly. And so when momentum goes below zero, that's usually a great place to ignore, or not ignore, but to be cautious. And in 2015, it was the May high, and by August, September, it was falling, and here we are, end of July, heading towards, this is just gently rolling over so far this week, but the histogram was pretty darn small on this most recent bounce. And if you look up here at the Russell, we're kind of where we were at 5 weeks ago. It doesn't feel like to me like we have a lot of momentum. So I think there's a guide there, and whether or not somebody says, well, don't invest in the Russell, just invest in the big stuff. I think it's the weakness of the Russell that gives us a clue that the rest of the market might struggle here. So anyway, I throw that out as a place to at least be aware of the damage. Now, I have this value line index, and this is where it's not market cap weighted. Each stock has the same weight, so it's 1, 1, 1, 1. And what you would see is that in this particular case here, we have a downsloping 40-week moving average, and on this downsloping 40-week moving average, that doesn't really happen in uptrends. But I will say that the market top does not happen usually right at the peaks over here. A lot of times it happens on farther onto the right-hand side, and it can happen up in here. But many times, like back in 2000, it happened when this was rattling down. This is the full stochastic of an 80-period full stochastic on a weekly chart. And what you see is the momentum got low but never really fired back up. And we see that stuck down in here. Now in 2011 and 2012 we saw the same thing, and then we had something called central bank quantitative easing worldwide. Bing, this thing jumped to the top. Maybe we're going to get that again. But in the meantime, we probably need somebody to recognize that the market is weaker. And we're sitting down here with a full stochastic thrust level not very high. And, when we go back and look on the left-hand side of this chart, when the full stochastic is wobbling around 50, that, quite frankly, hasn't been a good place to be involved in the stock market. So we fell down in 1998, rallied back up, kind of stuck in the middle, never really got high. But here was the actual market top in early 2000, and that was the NASDAQ market top. There was S&P was closer to September 2000, and it rolled down. But the bottom line is we're stuck in this middle zone. Then we go over to 2007, 2008. Well, it just literally ran right by here and lived down here for a year and a half. 2011, we had quantitative easing. 2014 was the end of quantitative easing. We had this drop, rally back up, and then this fell away, and the market top was in May of 2015. And so down we went, and we lived down here at the bottom for the next year. Now, in this case, we've been down here, and we bounced back up. We've made new highs. Well, that's not that unfamiliar. We actually did that back in 2000. That's kind of how the whole thing happened back then. So I throw it out as a reason to watch, but look what's going on with momentum here. This is rolling over just above zero, pulls back, and now looks to me like it wants to roll over below zero. And you can see the full stochastic almost gave us a sell signal this week. Still got a little bit of a heartbeat, but not a lot. And so it's at 60.75, and 60.38 is the signal line if it was to go below that. So you look at this, and as it wobbles below, if this was going to roll over right here, right now, I highlighted in blue where you have areas where it wobbles right around the zero level or just below. So this one down here in October 2016. I mean, there's something that could be said this wasn't very high in here. But over here in 2008, it never even got up to that level and rolled over. But when it rolled over below zero, that was a meaningful time to be aware of. And all through 2000, 2001, 2002, it just kept rolling over below or around zero, and that was meaningful. Back in 1990, there was a recession back then, and it rolled over there. 1994-95 was a particularly odd period because we didn't have any sort of recession. We had a market pullback, and then we raced off from there. So again, I'm just saying that there's a lot of conditions set up for it, and I think it's a pretty important place on the chart. Okay, we've gone through a lot here. There's so much to cover off this week, but I think the big thing is the US dollar hasn't done anything. That's a big one to be aware of. We're stuck right here in this range. So we broke down, rallied back up, and now we spent 2 weeks going sideways, and we don't have a direction. And to me, if the US dollar was to bounce off in terms of momentum and take off to the upside again, I think that would actually be what cracks the market. I think if the US dollar breaks down here, that would actually help the rest of the world. Real briefly, and I'm just going to highlight the facts or some of the interesting charts here. The emerging market currencies actually stayed up pretty strong this week, and this chart makes me a little bit more bullish towards commodities. Commodities typically follow the emerging market leadership, but when I look at copper, it actually wobbled up here, and that was nice to see. Copper is actually one of the better charts this week from all of the information out there. But I will say that the emerging markets, EEM, didn't do anything. There was no real good piece of news hiding in that market. So I'm going to go through, and I just want to make sure that we go through the rest of the world, and there's some critical information about where we sit. And I know a lot of people think, Greg, you're too worried about the rest of the world. But 50% of the S&P 500 is selling to the rest of the world, and it's that 50% of sales that I'm focused on. Who are they going to sell to if this market keeps breaking down? So here's the German monthly, and you can see the PBO is right at zero. Now, at this point, it's turned up, but if you look up here, it's hovering just around the 20-month Bollinger Band. It just, for most people, we have a downsloping 20-month Bollinger Band, and price action is right at it or around it. It feels a lot like some of these interim periods back in 2000, same idea. Now, you can see how nice and clean it was way back then. We fell below it and we just stayed below it. We fell below it and we stayed below it. We fell below it in 2011, got above it, pretty much stayed above it for a long period of time. 2015, back and forth across it. In 2018, back and forth across it, finally breaks down. Now it's rallied back up, but it hasn't rallied that well, and we're still above it this week. Again, we've got another 10 days to go in the month or whatever, 8 trading days or something. And so we'll watch to see where this ends, but if it starts to fall back below it, that's a pretty good place to be aware of. And again, if this momentum indicator was going to go below zero, you can see most of the big damage happened when this momentum indicator on the monthly charts was below zero. So we just need to be aware of that. Okay, let's go look at some of the other charts. Here's the DAX weekly. And again, this chart is almost ready to roll over, very close. The full stochastic's already given way and is turning down. So that would be a sell signal if you were using a full stochastic. Now, what we see here is this pullback and a bounce off here is a bull market signal usually, and then if it comes up here and it fails right away and rolls back over, it can wobble along here and be this nice big bull market. The real problem I have is, the US was going higher and hit new highs earlier this past week. The DAX kind of gapped up 2 or 3 weeks ago and is now working its way lower and has lost the support all the way back. It's well below the April high already, and it's starting to break even lower. And again, we saw that same thing on the NASDAQ 100 where it's just back below the the NASDAQ composite where it's just back below the April high. But this DAX looks like it's rolling over quite quickly. The momentum, the histogram is showing considerable weakness. And so the week coming up sort of becomes the week to defend a sell signal on the DAX. It doesn't mean the world is ending. It just means all of a sudden there's not enough momentum to carry the market higher. And again, one of the things we do see is that the German market has typically followed the U.S. market, and since January of 18, kind of when the trade tensions started, we haven't been able to see the DAX kind of behave that well, and we all know that the car sales aren't doing that great, manufacturing struggling a little bit. While the U.S. broader economy is consumer-based, we still have these big consumer products like cars not doing well. And on the RSI, we have a bear market signal, right? It touched down below 30 and hasn't been able to get above 60 or 65, and that's typically what we see in a bear market. So we want to be aware that the RSI has kind of been signaling that, and this is kind of where we would expect it to top out. So as the market behaves like this, momentum rolling over very close to zero, well, not really close to zero, it's up around 1.5. It's not euphoric. It's definitely not early 2017 where we're up 2.5 or 3%. We're down at 1.5. So just a different page, and we want to be aware of it. And again, it's the deep move below zero that said we were lacking momentum, and now on the bounce, we don't really want it to have a shallow bounce here. Okay, I'm going to go through these charts a lot quicker now that I've kind of laid out the thesis, but here's the RSI, barely struggling to get above 50 on the monthly. That's just not a good place to be on this chart. And then if we look at the CAC 5500, it's been spending over a year and a half at this level and hasn't been able to break through. And momentum's right near zero, just turning up this month. If it can hold it, you can see after the big month last month, it's really lost all of its momentum as soon as it got back to prior highs. So still not that bullish, and that's the problem, is we're just struggling to try and really get going here. Now, some people will say, well, it just made a new 52-week high, and I'll say, yeah, for about a day or something, and then pulled right back. But the concern we have, of course, is can everything get going? And when we go to the weekly chart, is we're stuck up here, and you can see literally we haven't done anything. We've been just gently moving our way lower, but it's the fact that we have this wave, this lower high, and now we're starting to break this trend line. And I marked this green arrow in late June saying, great, now here's the problem. We kind of tried to rally and failed, and it's that lack of momentum that's exactly what we're watching for as we go through prior highs. Okay, the Dutch market, same thing, capped out at the same level, flat PPO momentum on this monthly chart. When we go to the weekly, it's held up a little bit better. It's still, it's probably the highest close going back to July of last year. That looks pretty good. So that market isn't as weak. Here's the Swedish market, and the Swedish market I like to use as an indicator, and one of the things I was hoping to see this month was that it could break through this downsloping trend line in momentum, and that would be somewhat bullish, and we're trying, and let's not use a fine marker on here. Basically, we want to see it turning up. We want to see a big sort of upstroke like this, not a gentle sideways kind of guiding move. And so we're in this zone of trading for the last 4 months with no real upside momentum. When we go to the weekly chart, had a big down week but closed halfway. Lower momentum on the RSI, lower momentum on the PPO, and again, this one looks like it's ready to roll over probably next week. If it doesn't get any sort of upside price action, it'll actually give us another sell signal. Here's the Shanghai Composite, and again, it pulled back below this 25-year uptrend line, rallied up above it, and has just kind of consolidated sideways for 3 months while we work on trade deals. Here's the Shanghai Weekly, and you can see that this doesn't look nearly as bullish. We kind of ran up, fell down, and then this week we had a doji where we went sideways. No real technical damage with that, other than the relative strength is starting to break down again, and that usually doesn't bode well. It wasn't a big uptrend to begin with, and when it did start to break down, that was more problematic. Here's the Hang Seng, and you can see it's right at a major resistance level around 28.5. That was the highs back in 2015, ran above it, pulled back. We're sitting right around this 20-week moving average, and it can't really seem to get a heartbeat much above it. So that's a problem. Working our way through the weekly here, you can see the same thing. We're stuck around the 20-week moving average and just haven't been able to get going. We're sitting here with the PPO right at zero. So the real question is, can it get enough momentum to go above, or does it roll back over here? And if it did, I would expect it to actually drop quite quickly. So that's why I'm a little bit concerned. The Nikkei, the messiest chart, this 21,000 level goes back for years, right? This is 1995 and 1996. It was stuck around this level for years. In 2015, we got up to it and fell away. With all of the central bank easing and everything the Japanese government the central bank is trying to do, you could see that it briefly spent some time above it in 2017, 2018, fell below it in early or late 2018, and has tried to rally above it, but hasn't been able to do anything. And again, the central banks have been buying billions in ETFs to try and hold the market in place here. and I think it was even 3 purchases this week to try and hold things up. But we're sitting here trying to hold this level. We're below the 20-week or 20-month moving average, which is quite bearish. Typically, it's not usually this drawn out a process when we stall at these areas, but this has taken 6-8 months, and it just hasn't. Remember, the US came off this low and went all the way up to higher highs than the September highs, and this market just hasn't found any of that, much like the DAX. And here's the Nikkei, and again, bounced off this 21,000 level, and bing, you might think some central bank started to come in and buy something or whatever to hold it up here. But look at this PPO trend line. If this starts to break again and roll over here, I'd be quite worried. And again, look how far we are away from the September and January highs in the Nikkei. There's just been no momentum, and that's one of the reasons for my primary concerns around the rest of the world. Looking at Australia, this market's still been breaking out to prior highs. It's trying to get through its highs way back here in 2007. It's revisiting those highs for the first time 12 years later. Why isn't that moving? Okay. On the weekly, this chart's been sideways, down slightly for 3 weeks, but still closed near the high of from the open last week to the high this week, closed flat, no real change. I think the important thing is that momentum is way up here near a high, which is not a bad thing. It just means that it probably might need to come in a little bit. TSX Canadian market, again, struggling here for 4 or 5 weeks. Usually after 4 or 5 weeks, it's not really a bullish sign. So we'll continue to watch and see if it, or 4 or 5 months, we'll continue to watch and see if it can get anything going. But look at this momentum line here just coming in. Everything is lined up right around this point. This is a critical area. If it was to fail or turn up here, I'd make a lot of different decisions. It doesn't seem to have enough momentum right here to get going, and we'll show you that on the weekly. What you see is just, again, I said it was consolidating sideways for 4 months. Well, it's also consolidating on its 5th week. PPO momentum is just waning here, not a lot of strength. We saw this back in middle of 2018, and that's kind of as it started to roll away. It's still trying to hold above its 20-week moving average, but it wouldn't take much to fall through that. Brazil market, nice and bullish and trying to break up here. On the PPO, that's as good as it can get. We'd like to see that. Weekly chart, it was down a little on the week, but that's a selling tail if I've ever seen one, where you have a big push up, close at the bottom of the week, and then make a lower high, a lower low, and a lower close the following week. That's not that good on a weekly chart. So as we head towards the end of the month, we'll see where we close, but we have a big bar to work with from 2 weeks ago. So we'll see if they've got any more strength in the move. Here's the Russian market, and you can see it broke down to new 5-week lows, and quite aggressively. I would expect Brazil to kind of follow this model here. And if this rolls over again, that would be a concern. Okay, S&P, same thing. We're at the previous height of the wave here, whereas we made a higher high here. That's not bad. That's still very bullish to get back up to the prior high in your wave. So as you go, you continue to just kind of wobble around a nice high level. That, again, would be quite bullish normally. I will say that we have a bear market signal on the S&P 500 where we got below 30. We got down to 30, and we tried to rally back up, and I've drawn the line here at 60, but you can get all the way up to 65. But what you see here is lower highs on the RSI and higher highs in price. Usually that doesn't end well. So for us to roll over right here would be a little bit problematic. It wouldn't be a surprise based on this signal we got, but it can go, back in 2015, that's kind of what we saw, where we just got stuck under the 60 level, and that's what gave us weak markets. So we have the same sort of signaling. We just haven't seen the price action move yet. So then when it starts to move, somebody will be surprised. Okay, on the weekly, or this is the monthly, and we have that same kind of waning monthly momentum, and we'd like to see it start to turn up here. But if it was to fail here, that would be a meaningful signal. NASDAQ 100, again, lower highs in momentum, higher highs in price. That's a bit of a problem from a negative divergence. We actually got back to the 70 level. That shows us a bull market. Came down to 50. That's a bull market bounce. Bounces up. And as long as it stays above 50, that would still be bullish. We'd be happy. Okay, let me just check. One market I wouldn't mind showing you is the India market. And the reason I want to show you that is because it's one of the biggest economies in the world outside of China in terms of demographic population. And what we see here is this market was clearly up in the May, June, July area, doing quite well. And now all of a sudden it's testing this last gasp uptrend from the last, call it 9 months. And we have this really big trend line that it's been holding along for a long time, but look at the momentum trend going the other way. So we're at this inflection point, and it's a pretty meaningful place. So again, globally, the charts don't look as sweet as the US markets, and the internal US data was starting to get a lot weaker. I don't have many minutes left, so I just want to quickly highlight gold had a good week. I expect it to pause here. Just the momentum was getting a little bit euphoric, but this chart of the CRB just continues to grind sideways. And again, global economic demand would suggest that if things are going to get better, they're probably going to need raw materials. And look at this outside bar this week in commodities. That's just terrible. And where would the PPO be rolling over here if it rolled over now? Well, below zero. And again, it moves down pretty aggressively when the PPO is below zero. So a turn down here is not what we want to see. And again, the third one in a row especially would suggest that we really need to be more cautious if the market isn't going to hold up here. So I have all of these concerns mounting, and yet the price is up near the highs. And so again, you have to trade the market you're given. I'm just saying that there's a whole bunch of pressure to the downside starting to show up, and the big stuff in the US hasn't gasped or gapped down. Until that big event happens, you feel like you're just talking, over the fence and whatever, it's business as usual. I don't get that feeling here. We're in the middle of earnings. We've got this expectation for the Fed to acknowledge a weaker economy. Globally, the economies the charts seem to be turning down. Commodities are telling us there's issues. The bond markets have been telling us for a while there's issues. The US dollar hasn't got a direction. Until it does, we're really kind of struggling with that. So there's not a whole bunch that I can hold my hat on and say, well, it's this week. But I think what I'm watching for this week is to see if the momentum continues to wane. And if we get another week of this, I'd probably be, putting major markers in the ground. So with that, I want to thank you for taking the time to join me. Please check out next week. I think it'll be a pretty important one. Thanks again. Have a great week trading out in that market. Bye-bye.
The Chart Watchers newsletter features expert technical commentary about the current market from some of the industry's leading technical analysts. See what's really happening in the markets through their eyes and gain an edge in your own investing. The newsletter is packed full of insightful and educational articles intended to help you become a better investor. Whether you are brand new to charting or a seasoned technical analyst, each edition will provide a wealth of informative content. It's the best way to stay informed on all the latest news, events, updates, and additions here at StockCharts.com. Whether it's a new feature or blog, an upcoming conference, or a special sale, you'll hear it first in the Chart Watchers newsletter.